the conference that Rob went to in Tennessee, when Trump spoke, it's interesting, directly following Trump was the senator from Wyoming. And her last name escapes me at the moment. Loomis, I believe. I think it's Senator Loomis from Wyoming, who came up and said that her idea is to revalue the gold held by the Federal Reserve on behalf of the Treasury to a level high enough to purchase Bitcoin with some of the proceeds. You can't make it up as well, in that all of the central bank balance sheets that hold gold have it in an account called the gold revaluation account. It's the name of it. The head of the Dutch National Bank has talked about this for quite some time, revaluing the price of gold. And, when you look at the amount of gold that has been accumulated throughout all of Europe and throughout the BRICS nations, it would certainly benefit the central banks. It would behoove all of them. Over my shoulder, you got Roosevelt there. In essence, that's what he did when he confiscated gold in 33. He devalued the dollar by 40%, thereby revaluing the price of gold by 40%. It's something that is being noticed. When you see a senator from Wyoming actually say that she wants to float a bill to do that, it is being noticed. You got Jim Rickards saying $27,000 an ounce gold by dividing the gold supposedly held at Fort Knox by M1. You got others that say other things. In a world where Bitcoin can be $100,000, no big deal. Why couldn't gold be revalued to $130,000 and thereby render our $36 trillion debt solvent, offset with the amount of gold that would more or less make that a wash? I guess it could. In theory, the Treasury says any country that wants to deliver their gold to the U.S. Treasury will pay them 130 grand an ounce. Okay. Isn't that what the price is? Yes, it's inflationary. Yes, it's going to have ramifications. But when you realize that we are entering that period of time, Rob alluded to the fact we're insolvent, approaching, I think we're at 120% or so of debt to GDP. Where I come from, those countries way back when, anything over 100% debt to GDP were considered banana republics. And those were usually the countries that had questions surrounding their electoral process, their judicial system, all of the things that have plagued this country. I mean, you could argue we have been toting the banana republic line for quite some time. To me, the common thread in all of it is a marriage between blockchain technology and gold and a new system. And to peg a new system that has lost all credibility to something that inspires credibility. Yes, I see it. It's right here on the blockchain. It's audited independently, continuously, and it's pegged to and backed by gold. The only way you make that work, and that it's interesting, the Swiss had a 40% gold backing way back when. That's the number that the BRICS nations have said in theory they chose. And I think that is something that would work. You put gold at a much, much higher level. You peg it to gold, put 40% gold backing or whatever it is, still gives you monetary latitude. And then Craig brings in Judy Shelton. I wonder if they will nominate her to one of the governor positions. She won't replace Powell anytime soon unless he steps down, as he has, I think, 2 years left. But she is an advocate for the gold standard, and more relevant to me, everyone talks about de-dollarization. Yeah, that's important, right? I mean, the settlement currency, it's important. But to me, it's more along the lines of where's everyone putting their excess? And it used to go into treasuries. And the lack of demand for treasuries, to me, is the real problem. Who's going to finance our debt? Does it become hyperinflation as the Fed is the lender or the purchaser of last resort, or yield curve control, as Craig has talked about forever? These are all possibilities. What Judy says is, well, hey, look, no one of any intelligence would buy our treasuries of any duration. I think they're uninvestable right now, personally. She didn't say that. I'm saying that anything 10-year duration or higher is uninvestable. You're out of your damn mind to do it. But she says, well, we'll just have it redeemable in gold.
The narrative surrounding gold, silver, and the evolving financial system remains as dynamic as ever. The discussion is no longer limited to traditional economic measures. It's now deeply intertwined with geopolitics, technological shifts, and societal expectations. Andy Schectman's insights shed light on these intricate dynamics, offering a perspective that blends history, economics, and modern challenges. A pivotal moment in the discourse around gold was highlighted during a conference in Tennessee, where both Trump and Senator Cynthia Lummis of Wyoming spoke. Lummis's proposal to revalue the gold held by the Federal Reserve to a level that could support purchases of assets like Bitcoin illustrates the innovative, and some might say audacious, ideas circulating in the financial world. Such a move would not only underscore gold's enduring value, but also signify a radical shift in how governments manage monetary policy in an era of digital currencies and decentralized systems. To put things into perspective, central banks globally have long held gold as a cornerstone of their reserves. What's fascinating, as Schectman points out, is the existence of the gold revaluation account on central bank balance sheets. This account essentially holds the potential for governments to revalue gold, thereby addressing monumental debt burdens. Historically, we've seen this playbook before, most notably in 1933 when President Roosevelt confiscated gold and devalued the dollar by 40%, effectively revaluing gold to stabilize the economy. In today's context, a similar move could transform the financial landscape. Some analysts, like Jim Rickards, suggest that gold could be revalued as high as $27,000 an ounce if measured against M1 money supply. Others speculate even more astronomical figures, envisioning a price tag north of $130,000 an ounce to offset U.S. national debt. The allure of such a bold strategy lies in its potential to restore balance sheets, mitigate inflationary pressures, and introduce a stable monetary anchor in a world increasingly skeptical of fiat currencies. This skepticism is not unfounded. The U.S. debt-to-GDP ratio is hovering around 120%, a level historically associated with economic instability. In fact, such ratios often invite comparisons to banana republics, marked by questionable governance and fiscal policies. The idea of pegging a new financial system to gold isn't just a nostalgic nod to the past. It's a forward-thinking strategy that marries the stability of gold with the transparency of blockchain technology. Imagine a system where every transaction is verifiable, audited in real time, and backed by a tangible asset like gold. This isn't science fiction. It's a logical evolution of monetary policy in a digital age. The BRICS nations, for instance, have floated the idea of backing their alternative reserve currency with gold. Historically, the Swiss maintained a 40% gold backing for their currency, a figure echoed in BRICS discussions. Such a framework could provide monetary flexibility while restoring trust in the system. While the idea of a gold-backed digital currency is gaining traction, the challenges are equally significant. Judy Shelton, an advocate for the gold standard, has been vocal about the necessity of such reforms. Her suggestion to make treasuries redeemable in gold could, theoretically, reignite demand for U.S. debt. However, the current state of treasuries paints a grim picture. As Schectman rightly points out, longer duration treasuries have become uninvestable. With foreign buyers like China and Japan stepping back, the U.S. Federal Reserve is left as the buyer of last resort, a practice that risks hyperinflation. In this context, gold and silver emerge as safe havens. They are not just hedges against inflation, but also shields against systemic risk. The appeal of these metals is not limited to central banks. Individual investors are increasingly recognizing their value. As the liquidity crunch intensifies with mechanisms like the Bank Term Funding Program, BTFP, ending and reverse repo markets nearing zero, the financial system is entering a precarious phase. This scarcity of liquidity could exacerbate existing vulnerabilities in overleveraged and undercapitalized banks. Schectman's perspective resonates with a broader audience because it ties these macroeconomic issues to tangible realities. For instance, the lack of demand for U.S. treasuries is not just an abstract problem, it's a direct consequence of declining confidence in the U.S. dollar. The weaponization of financial tools such as sanctions and asset freezes has further eroded trust. When countries like Russia and China see their reserves confiscated or sanctioned, the appeal of holding treasuries diminishes significantly. Instead, these nations are turning to gold, a tangible, unconfiscatable asset that offers stability in an increasingly unstable world.
We've all lived through bizarro world for the last 4 years on many levels. And I think people are tired of bizarro world and they're tired of a country that favors lifestyle over merit and hard work, that favors equality over equal opportunity. And I think we're sick and tired of watching our country and the things that made this country enviable to most of the world, our culture, be whitewashed right out from underneath us. The judicial system, the electoral system, the immigration system, the lawlessness, the wokeness. And it's a breath of fresh air And I think that has also translated into the risk on trade where, there's no reason to be defensive anymore. It's hope springs eternal, but that's misguided. And I think that's exactly what the bullion banks were counting on and hoping for, and use that opportunity to indeed flush out, the weak-handed money managers that drop the price down below the levels that trigger selling and selling and selling and selling, and they're covering. But, to Craig's point, the debt, that's not going anywhere. In fact, it's obviously will probably get worse in a weaker dollar environment with low rates and a weak dollar. That's hugely inflationary. Inflation is coming. The loss of purchasing power is coming. And really what this translates into, which is somewhat concerning for a lot of the country, is again, like the Cantillon effect, the wealthy will get wealthier as their assets go higher in price, which ultimately will translate into price inflation as that trickles down into the economy. We've seen this playbook over and over and over again, and pivoting away from inflation or fighting inflation when they're 65% away from their target, when Trump is inheriting an economy where the numbers that he supposedly, or the book, the economics that he is inheriting are far from what we're being told. I mean, inflation is much higher than the 3.5% and that we're being told. Unemployment is much higher than the numbers that we're being told. The economy is in much worse shape. With what we saw happen in Lindsay, Oklahoma a few weeks ago, I find to be a kind of a red flag. And the fact that it's gotten virtually no attention whatsoever by the mainstream is absolutely crazy to me. And, Powell's talked about bank consolidations. I think the banks are massively over leveraged and undercapitalized, and watching rates on the back end go higher only hurts them more. But when the bank in Lindsay, Oklahoma failed, 50% of the uninsured deposits, they're gone. Boom, vanished. When Silicon Valley Bank failed and Signature Bank, they were all bailed out. Hundreds and hundreds and hundreds of millions of dollars. Oprah's money, Oprah Winfrey's money, the tech startup money, bailed out. This little podunk bank in Lindsay, Oklahoma fails, and only 7 million in uninsured deposits, only 50% are returned. The other 50%, I would argue, is the first bail-in this country's ever experienced since the legislation was written, and there's not a word of it on the mainstream. And I guess if I were going to play devil's advocate in all of this irrational exuberance, and I think some of it's justified, I do. I think it's time to be optimistic for getting our culture back, getting our country back. That's a good place to start. The financial side of things, we're a long way from fixing that. But if I were to throw out one concern, it's that if there really is a deep state, if things really are planned, my biggest concern is they're setting up for a fall. That you look at the BTFP, the Bank Term Funding Program, it's over. You look at the reverse repo market, it's almost down to zero. The liquidity is being yanked from the system right at a time when the banks are massively over leveraged and undercapitalized, and we should expect to see long-term rates continue to move higher. That's an unresolved problem. And so while I am very optimistic, and I think it is very optimistic ultimately in an inflationary world to expect metals to do well at some point after this sell-off commences and or finishes, I just think that it's also justifiable to be cautiously optimistic.
The narrative around gold and silver is not merely theoretical. It's deeply intertwined with real-world economic shifts, geopolitical upheavals, and the evolving financial ecosystem. As the global economy transitions into a multipolar world, the role of precious metals in providing stability, security, and long-term value has never been more apparent. Andy Schectman's insights offer a comprehensive perspective on why these assets continue to be indispensable in uncertain times. The ongoing trend of de-dollarization is one of the most pivotal factors driving the demand for gold and silver. Nations across the globe are actively seeking alternatives to the US dollar for trade reserves and settlements. This movement is not simply a rejection of the dollar, but a response to geopolitical realities and economic pragmatism. The weaponization of the dollar through sanctions and asset freezes has alienated many nations, pushing them to explore more neutral assets. Gold, with its lack of counterparty risk and universal acceptance, naturally emerges as the preferred choice. The BRICS nations, Brazil, Russia, India, China, and South Africa, are leading this charge. These countries are not only diversifying their reserves, but are also building parallel financial systems that bypass the dollar altogether. Recent discussions around a BRICS currency backed by commodities and potentially gold underscore the growing relevance of precious metals in the new economic order. By anchoring their currency to gold, the BRICS nations could establish a stable and credible alternative to the dollar, further accelerating the de-dollarization trend. This shift has profound implications for gold and silver prices. As central banks continue to stockpile gold, the supply-demand dynamics are tilting in favor of higher prices. In 2022 alone, central banks purchased over 1,000 metric tons of gold, the highest level in decades. This trend is expected to continue as countries seek to insulate themselves from the vulnerabilities of fiat currencies. Silver, too, is benefiting from its dual role as a monetary and industrial metal. Its critical applications in green technologies, such as solar panels and electric vehicles, are creating a structural demand that complements its traditional use as a store of value. For investors, the current environment offers a unique opportunity to accumulate gold and silver. As Schectman notes, the recent sell-off in precious metals prices should be viewed as a buying opportunity rather than a cause for concern. These corrections are often driven by short-term market dynamics, such as profit-taking or speculative trading, and do not reflect the underlying fundamentals. In fact, the long-term outlook for gold and silver remains overwhelmingly positive, supported by macroeconomic trends and geopolitical realities. One of the most compelling arguments for owning gold and silver is their performance during periods of economic and political uncertainty. Historically, these metals have acted as safe havens, preserving wealth when other assets falter. During the 1970s, for instance, gold prices soared from $35 to $850 an ounce as inflation eroded the purchasing power of the dollar. Similarly, during the 2008 financial crisis, gold and silver provided a refuge for investors amid widespread market turmoil. Looking ahead to 2025, the price predictions for gold and silver reflect their growing importance in the global financial system. Analysts project gold prices to surpass $3,500 per ounce, driven by continued central bank demand, geopolitical tensions, and inflationary pressures. Silver, with its unique blend of monetary and industrial uses, could see even more dramatic gains. Some forecasts place silver prices above $50 per ounce, fueled by its essential role in renewable energy technologies and the broader transition to a low-carbon economy. These price projections are not merely speculative. They are grounded in solid fundamentals. The supply of gold and silver is relatively inelastic, meaning that increased demand is likely to drive prices higher. At the same time, the declining trust in fiat currencies creates a structural tailwind for precious metals. As Schectman points out, the erosion of purchasing power in fiat currencies is not a hypothetical scenario. It's a reality that has been unfolding for decades. The role of gold and silver in preserving wealth becomes even more critical when viewed through the lens of currency devaluation. Since the U.S. went off the gold standard in 1971, the dollar has lost over 85% of its purchasing power. This decline underscores the importance of owning tangible assets that can withstand the test of time. Gold and silver, with their intrinsic value and historical significance, offer a level of security that fiat currencies cannot match. Schectman also highlights the growing appeal of gold and silver among central banks and institutional investors. The lack of demand for U.S. treasuries is a stark indicator of shifting preferences. With foreign buyers stepping back from the treasury market, the Federal Reserve has been forced to step in as the buyer of last resort. This practice, while necessary to stabilize the market, carries significant risks, including the potential for hyperinflation. In this context, gold and silver emerge as the ultimate safe havens. They are not just hedges against inflation, but also shields against systemic risk. Unlike fiat currencies, which are subject to manipulation and devaluation, gold and silver retain their value over time. This stability is particularly appealing in a world where economic policies are increasingly unpredictable. The potential for gold and silver to play a central role in a new financial system is also worth considering. As Schectman notes, the idea of pegging a new currency to gold is gaining traction. This concept is not just theoretical, it has historical precedent. The gold standard, which linked currencies to a fixed quantity of gold, provided a stable monetary framework for much of the 19th and early 20th centuries. While the modern financial system is more complex, the principles of transparency and accountability that underpin the gold standard remain relevant. In conclusion, the case for gold and silver is stronger than ever. These metals offer a unique combination of stability, liquidity, and growth potential, making them indispensable in today's economic climate. For investors, the key is to adopt a long-term perspective and recognize the value of these assets as foundational elements of a diversified portfolio. As Schectman eloquently puts it, the real value of gold and silver lies not just in their price, but in what they represent: trust, security, and enduring value. As we navigate the uncertainties of the 21st century, gold and silver stand as timeless beacons of stability and opportunity. Whether you're an individual investor or a policymaker, understanding the role of these metals in the global financial system is not just important, it's essential. For those willing to embrace their potential, the rewards are not just significant, they are transformative.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.